Okay, so on the class, December 2nd, 2025. So this week and next week is chapter 3 taxes. I like to break the taxes chapter up into 2 full weeks to give plenty of time to just kind of slowly go over it. Taxes can be daunting, be complicated, hard to understand. There's a lot of nuances. But I think it's a really good chapter. I would encourage you to read it. You'll learn a lot if you just read it. Hearing yourself say it in your head. To get a pretty good idea on, what taxes are, what's adjusted gross income, what's taxable income, what's the difference between the two, what the tax brackets are, what a tax bracket is, and then how to actually figure out what you owe in taxes based on what you make. This chapter teaches all that. Before I jump into taxes, let's take a look at the stock market. What's the first thing you notice? Over here.
Long stock is down.
Huh?
Currently down.
The stock market is down, right? And when I say stock market, I refer to the S&P 500. But there's three main, actually there's four if you count the Russell, but there's three kind of main stock markets. Indexes where all these stocks are, the prices are gauged on. The S&P, the Dow 30, and the NASDAQ. I think it's the NASDAQ 100. I think they have 100 companies listed on their index. So the first thing you see is it's going down. It's not just going down. 1.24% a day is a lot. That's a big loss. That means there's really nothing up. Everything's weighing it down. Why do you think that is? Give you a hint. It's the biggest lettering on the page. What is that?
What's yield?
Well, I was just gonna ask, does anybody know what that means?
Like all the stocks combined? No?
Yield refers to something else. That pretty much says it all. I mean, if you're kind of financially savvy and been in the industry and read enough, that really says it all. Like, well, that, and then what's directly underneath it tells you exactly what you need to know as kind of a retail passive investor on what's happening, what's causing the bloody day. So stocks sink, you know what that means, right? They went down. Yields rise. That actually has to do with the bond market. The yield from bonds is going up. So last week, I don't pay any attention to bonds, so I don't know what the numbers are. But just for example, last week, let's say on average, bonds were yielding 2.3% a year on a 10-year bond. Okay, so you were guaranteed that 2.3% interest for 10 years. This week, maybe they're at 3.5 guaranteed, right? So if you buy them this week, you're locking a 3.5% annual gain guaranteed every year for the next 10 years, right? So they became a little more enticing than last week, right? Last week was, what they say, 2.6, whatever. This week is 3.5. 3.5 starts to get up there to be not a terrible number for a guaranteed return, right? Bonds are guaranteed outside of the company going bankrupt, which is a conversation for another day, but for the most part, bonds are pretty much guaranteed. And so when you see bonds go up, the demand to invest in bonds go up, it's really bad for stocks because it signals that a lot of investors and a lot of like institutional investors, the big fellas with all the money, they're uncertain about future of stock market. They want to lock in some gains. They want to put their money where it's safe, so they can't lose, right? People hate losing more than they enjoy winning in general, right? Making money's fun, losing money is crushing, right? So they see something. They're looking forward with their $100 billion invested on, I don't mean like one person, but like an organization's 401k plan with $100 billion invested. they're looking for, they see something they don't like, so they're turning to bonds. And they're the ones pushing that bond yield up, because it comes back to supply and demand. The demand for bonds has gone up, therefore it pushes that price up a little bit. So that's the relationship with the stocks and the bonds. Rarely do you see stocks go up and bond yields go up, but it does happen. I think it happened during COVID. At one point, oil went up, stocks went up, bonds went up, interest rates went up, gold went up, silver went up. Like all in the same like 1 month period, 3 week period, which is like had never happened before because it made no economic sense. Because they're always kind of a hedge against each other, right? So you see stocks go down, and it's no surprise then to see gold go up. Why does gold go up when stocks go down? What is gold considered?
I don't know, a safety
What do you
net.
think, Silver? Why do people invest in gold in the first place? Why is it valuable? Hmm?
There's like a finite amount.
There's a finite amount. It's got a million uses, right? Probably the most useful metal. I don't know if that's true, but up there. And just over time, it's become this store of value, right? It's just a place to put your money that's safe. Gold's never gonna crash 30%. I mean, I guess it probably has, but it's highly unlikely gold's gonna crash. When gold hits a plateau, hits a peak, then it stays there a while. It may come down over time, but gold is safe. I guess often said gold is a safety net to put your money, just like bonds. But people don't like the bond yield. They're not happy with just the 3.5. These investors, they say, well, I'll just throw in gold. We'll push the price of gold up because we have that power. We'll push it up to 4,000 now. We'll make 20% in the next 3 months. Yay, we made money. Everybody else lost. We don't care. That really is kind of the mentality. That's the power they have. So, and then lingering uncertainty. That's the key word. Anytime the stock market itself is based on certainty versus uncertainty. And really the level of uncertainty in the market. How uncertain are things are good? You can never be fully certain. You can't look forward, say, well, I'm certain the stock market's going to go up. So it becomes a level of uncertainty. I'm fairly certain there's only a little uncertainty I'm going to invest. But when uncertainty rises, when there's more uncertainty, that's when you see people, the big fellows start selling off large chunks of stocks and then going into bonds or gold. And what's causing the uncertainty? President Trump's tariffs. That's still lingering, right? Still out there. That it has not been resolved. The tariff situation lingers on, and it causes this uncertainty. And on the Fed, what was the Fed? Somebody, what was the Fed? We talked about it week 1. The Fed. We've all heard it. The Fed. What's the Fed up to this week? They met in Jackson. Remember, they met in Jackson.
Oh,
Week 1.
Federal Reserve.
The Fed is the Federal Reserve. Do you remember what they do?
They're doing the CPI anymore.
Uh,
For the year.
The Fed might do the CPI. I don't know actually who does that. The Fed thing, they have to do with inflation, but the Fed controls the money supply in the United States. They have a handle on and a good idea on how much money is flowing to and from consumers, businesses, what businesses, and then they can inject themselves into the economy because they are not part of the federal government. And so they're supposed to be the good guys. And to be fair, in my lifetime, the Fed has generally been really good. They have made really good fiscal policies. The 08 housing crisis could have wrecked our complete financial system, but the Fed stepped in, pissed a lot of people off, and they bailed out all the car companies, bailed out a lot of banks, pissed off the regular Americans like myself because it just didn't seem fair. But by doing that, they saved America's financial system. So they did what they had to do. I'm sorry, I know this is probably confusing if you're not familiar with it. It's fine. This is on the exam. We're just talking here. We're just chatting fine. This is good stuff to know, and as you get older, and if you choose to go down the path of finance or investing, a lot of this stuff will make sense, because it's not that complicated. You gotta be around it enough for it to kind of put the pieces together. Okay. I guess we're right there. Anybody have any questions on the market, curiosities? Anything going on? Anybody invest in something special I need to know about? Or, simulator?
There's some good ones. I just
Anybody?
invested in, ChatGPT.
Did they go public?
I don't know if it's actually ChatGPT, but YieldMax AI and Tech Portfolio.
Oh, I
So it's
see.
like a
But
AI company now.
it's called an ETF, yeah. It's where you have a bunch of, they just
Yeah.
track a bunch of like high risk AI, something, so. Okay, all right, so we're gonna shift to taxes now. Again, I'm gonna try to keep this as less boring as possible. I'm not rushing through any of this. I'd like us to all get a pretty good idea of, the material before I move on. So before we get in, let's just talk about what are taxes? What is a tax?
Money the government pays for us for funding of something.
Okay. What are taxes for? Why do we pay them? Why do you pay taxes? What do you think, Taylor? Why do you pay 20 to 25% of all your income back to the government?
Because the government needs it for like schools and stuff.
Okay, yeah. Why else?
This is why they don't go to jail.
Okay, absolutely. Yeah, so taxes are for that. They are our payback, right? The government does so much for us. I mean, I believe in taxes. I just, I believe obviously there should be a cap on taxes. Yeah, we pay the government, all workers who earn an income in the United States pay a certain percentage of their money back to the government. So they can build I-25. So they can build a nice school for your future children, right? So the state, Casper College is mostly state funded, so, but in state tax, so we can have this classroom, right? Built this brand new fine arts building, just finished it last year, it was like 38 million. It's state of the art, beautiful building, right? That's all tax money, most of it's tax money. You do get some local donors who pitch in, so they can throw their name on it, but for the most part, that's all due from taxes, right? So I don't think taxes are a bad thing. Again, it comes to how that process looks and what the cap is on them. I actually think the United States is pretty fair. Most people don't pay more than about 20%. You go to some countries and it's 40, 50, 60% of your income. Straight back to the government. How do you live? You're making minimum wage anyway, and then you get half of it back to the government. It's hard to live. I think the United States is pretty fair. I actually, if you want my own opinion, which nobody asked for, but I'm gonna tell you anyway, I think the rich are overtaxed. I don't think it's fair that they have to get 50% of their money. Just because you made $1 million this year, it's not fair that they should have to give them 500,000 of it back to the government, right? I mean, that's how I see it, but I get it. Because the government needs money.
Isn't it only like the top, like 1% of income earners are paying like 70% of the taxes?
Yeah.
And then the people above them don't pay taxes?
Yeah,
Because they know the tax codes and they only take out so much at the end of the year to be taxed on. So like they can get by those taxes.
They
So it's only like the top
practice tax
1% income earners who are usually working.
Yeah, so what he's saying is, and I don't know the number, the percentage, but it's like the top 10% earners in America pay like 90% of all the taxes paid in America. And the rest of us who, make middle class earnings make up the final 10%. I don't know how you fix it. I'm not here. I have no idea. I don't know enough about it to even make a proposal, but I just don't think it's fair. I mean, I guess, once you get into the billions, you're talking the billionaires, you know, I mean, because how much more do you really need? You know, but I get, yeah, I mean, there's people who work hard and spend their life building a business or building a career, climbing the ladder, and they finally get to that 2-3 million a year mark, only to turn around and get half the battle. Like, that doesn't seem fair to me. I feel like those people should pay their 20-25% like the rest of it and get to keep a large chunk of it, but anyway, kind of go into the chapter again. It's gonna be slow. And I'll try to keep it interesting. All right, so we're gonna first look at some of the different types of taxes. We're gonna calculate taxable income and the amount owed on federal income tax. We're just gonna look at federal. We're not gonna go to state income tax. Why don't I want to go into state income tax? But,
We don't have one?
yeah, Wyoming doesn't have state income tax. Go to Colorado, you're gonna wanna know that. Actually, if you have TurboTax, you don't need to know any of it, but yeah, Wyoming doesn't have a state income tax. So I don't really bother with it. The process is actually very similar anyway. Look at preparing a federal income tax return. We probably won't get to that till next week. And then some appropriate tax strategies for various life situations. All right, so tax planning should be throughout the year, right? Once you start working, you know, and you're kind of settled, your tax situation is never gonna leave your mind, right? It's just gonna be there. It's just kind of there lingering. You know, what are my taxes gonna look like at the end of the year? You need to kind of keep an eye on it, because you certainly don't want at the end of the year to find out you owe $11,000 in taxes. You don't make that much money to begin with, so you don't have it. But yeah, you always kind of want to think about your taxes and your tax situations throughout the year. Definitely want to know, you know, current tax laws. Obviously, nobody's going to know all the tax laws, but kind of your basic ones, like your taxable rates, your marginal rates, what the standard deduction is, things like that. You're going to want to know that kind of every year because it changes a little bit. You want to maintain complete and appropriate tax records, then making purchase and investment decisions that can reduce your tax liability. Right? Kind of what Austin brought up about there are those incredibly wealthy people who seem to pay nothing in taxes. It's because they haven't, but they have hired somebody who has mastered tax code, tax laws, and they know how to minimize that tax liability, right? Does anybody remember who Mitt Romney is?
Sounds familiar.
He ran for president against Barack Obama the second time, 2012. Okay.
Okay.
He is a very wealthy, I don't actually know where he got his money, but he's from Utah. He owns land in Wyoming, western Wyoming. Wealthy guy, don't know where he got his money, but he was extremely wealthy. And when he was running for president, it came out that he was a Republican, the Democrats did the digging and they found he was only paying like 11% taxes of all his income. And the guy was making, you know, 80-90 million a year doing something. And while his housekeeper, the lady who was cleaning one of his mansions, was paying 22%. Right. And it set off a lot of it upset a lot of people. The optics were bad, right? The guy made 90 million. He's only paying 11% of his money back to the government. But his housekeeper, who's probably only making 60-70,000 a year, she's paying 22% of that income. It's not fair, right? And it was a bad look for him. And he didn't handle it well. I don't remember what he said. Somebody caught him on recording saying something, just something about, well, she should work harder or she should get a better account, you know, something smug. And it's like, well, if you're making that,
Say like a billionaire, come on.
you can't afford an account, right? Somebody caught him on recording and that hit the news and he never had a chance to begin with. Obama was gonna walk away with it and he did. But this was just a really good example about Mitt Romney has excellent accountants. He knows, or he or she, whoever the accountant is, knows how to manipulate that, where to put money, what to buy and when. So it completely minimizes your tax liability. All right. April 15th, everybody know that that's tax day or tax freedom day. That's the day you have to have filed your taxes for the previous year. So April 15th, 2025, you had to have filed your taxes completely for the 2024 year. And that's every April 15th. Now, there's some leeway on that. If it falls on a Saturday or Sunday, they usually stretch that out to the Monday of the next week. So it can be as late as like the 17th. But mid-April, you have to have filed your taxes. Unless you filed for an extension or there's another filing you can do, so you don't actually have to file them by the 15th. But so key to know, and I think it's on, I'm sure it's on the homework, it'll probably be on the exam. I don't know if there's an exact date, but mid-April. So the whole idea of taxes is if you pay your fair share of taxes, you're doing your duty, but there are plenty there are plenty of tax benefits you can take advantage of if you do your research, do your reading, and try to understand it all. There's a lot of ways to reduce that tax liability. All right, so some of the different types of tax. What's the sales tax?
You buy something, the company charges, or like adds a little extra fee afterwards that you pay them.
Right. But you bought that hat, you bought it. You bought it at $24.99, but did you pay him $24.99? No, you paid him $24.99 plus 5%, right? I think Lyman's 5% now. Yeah. So you pay the 5%, you paid that. The company that sold it to you doesn't get to keep it. That's passed through right to the federal government. State government. I actually don't know if sales tax. I think sales tax is state. Anyway, that's state. That's a sales tax. When you buy, there's a tax put on there. States get to decide though on like food. Like Wyoming does not have a sales tax on food. You go to the grocery store, there is no sales tax. Your bill comes to $89.13. You pay $9.13. No extra 5% added to the background. All the 5 states, in recent years, all the 5 states had a general sales tax. I don't know if we I think we do, because we still have it on non-perishable goods. Still have a sales tax on anything but food. All right, then you have an excise tax. This is imposed by the federal and state governments on specific goods and services, like specialized gasoline, cigarettes, alcohol, tires, air travel, hotels. Anybody go to Jackson? The excise tax for hotels in Jackson is like 12%, right? It's an additional tax that they can throw on there, specialized tax. It's not illegal. They can put it on. You don't have to pay it. That's their they don't like it. Stay in Wilson, Idaho, and drive over. Stay in Pineville, Wyoming, drive for an hour and 20 minutes to the mountains on solid icy road. I've done it. So just know it's kind of like an additional tax. So buying a pack of cigarettes, you're still gonna have the sales tax. There's an excise tax also built into that price. It's either gonna go back to the federal or state, or probably a little bit of both. And then there you have different kinds of property taxes. You have a real estate property tax. I'm sure you've all heard of this. If you buy a house in Casper, you pay an annual property tax. Property taxes went up this year. Actually, the property tax in Casper went down significantly this year. I don't know why. It was all positive. It was really like a really good year. They dropped like 25%, which is like unheard of.
Is that based on the value of surrounding houses?
Right, yeah, well, there's a lot that plays into it.
Oh,
The neighborhood you're in. Yeah, the surrounding have the proximity to schools, proximity to a Walmart, and really. It has to do with the value of your house. And the value of your house has a lot to do with that kind of stuff, where you're located. Some areas impose a personal property tax on like smaller things. Wyoming does not have this, but you know, there might be like a personal property tax on a boat or a really nice table for farm equipment. You might know this, right? Because I don't. Is there any sort of property tax, personal property tax on livestock?
I don't think so.
Yeah, I've never heard of it. I'm sure I grew up on a ranch. I would have heard of it. Would have heard of the old timers fishing about it. I never did. I've always assumed we don't, but I don't know for sure. Okay, so then takes us to more types of taxes that you're gonna encounter, taxes on your wealth. An estate tax is imposed on the value of a person's property at the time of death. This is a federal tax. States don't get a say in this, which means everybody pays this, or everybody's subject to paying it. Again, I don't want to get too far off topic and just like bore you of old knowledge that I acquired, but I know that you used to have had a net worth of 4 million or more, even have to pay an estate tax. And then Trump raised that to like 12 million. So his first term. And I don't know if Biden did anything to that in that 4-year gap between Trump's two terms. But I believe it is still, you have to have a net worth of 12 million or more when you die to even be subject to the estate tax. Otherwise, it's just passed through. You can just push it down the line as an inheritance, which takes us to an inheritance tax, which is another tax that's levied on the value of property bequeathed by a deceased person. Wyoming does not have an inheritance tax, which is good. To me, it's just ridiculous. It already took place here, basically. Like it's, I guess if you didn't have a net worth of 12 million, you avoided that, and so then this is tax. But if you did, then it's double taxation. Right? You're getting taxed on your estate's getting taxed when you die, and then the person you bequeath your property to, they then get taxed again on the same item.
So I mean, even after death, the IRS is after me.
Well, they're after you.
And stuff.
They're after your family. But don't worry much about it. I mean, know what inheritance tax is, but if you stay in Wyoming, you won't have to worry about it. All right, and then taxes on earnings, income tax. Each year there's a cap on the maximum amount of wages subject to Social Security. It's 100 in 2023 is 160, 200. Income tax may be levied by the federal, state, and local governments. Only 7 states do not have a state income tax. Wyoming is one of them. We only worry about the federal income tax. Okay, let's take a break. So a lot on that. Okay, like 5 minutes, and we'll look at how do we calculate taxable income. Anybody here do their own taxes? Did you say you did? TurboTax?
Says I have pending trades on the investor PDF. Does that mean I gotta wait a day till they go in or what?
Yeah, I don't know why there's that stall. Sure why it makes you wait. Go down, go down.
One of these is gonna go through.
Well, I wanted to say too, real quick, there are a few of you that did not finish homework, chapter 2 homework, or take the quiz. You can still do that. You have until, on the quiz, you have until like the 10th of September. You'll lose 20%, but you'll still get the points. The homework you have until the 14th of September, still turn that in and get points. Chapter 3 has been assigned and is not due until next Sunday. You got 2 weeks for it.
You excited for the game tonight?
Yeah.
Have you played Western Nebraska yet? Yeah. Oh,
But we had bad team last week. This is bad,
what makes the team better this year?
players who wants to be over there in the board.
We're gonna show up.
All right, a couple of things I meant to mention at the beginning of class. First one, this Sunday morning, this coming Sunday, September 7th, is the T-Bird Trek. The race that the college puts on. It's a 5K, 10K half marathon event. It's a big event. Usually 300 to 400 people run it all over the community, all over the state, travel to do this. It costs a lot of money for me, but it's free for students. I'm taking at least one class from Casper College. You can do it for free. I do offer extra credit to any of my students who do this. If you run the 5K, it's 5 points, 10K, 10 points. If you do the half marathon, 15 extra credit points. So, this is the web, you can just kind of Google it. Make sure you hit in 2025 because it tends to bring up last year's. Once you get to it, just click there to register. There's a passcode you need to get it for students to get in for free. I think it's CC student. Not that, it's Casper College student. If it's not that, it should be on one of the TVs around campus that has the events coming up, right? I've seen it, so like I know it's there. So if you're interested, do that, get registered, run it. Let me know you did, so and I'll double check with the registrations if you did, but then you'll get your script. And then
Volleyball team.
Hmm?
Volleyball team at some point, game today, something.
But
I tried.
if you run the T-Bird Trek, you will.
I'm in Texas, I can.
Hmm?
I'm in Texas, we have a pretty.
On Sunday?
Yeah, we're leaving tomorrow.
Yeah, I can't do that. It's a fair shot. And then the next thing I wanted to talk about, this is Wednesday, September 17th. It's an event. I can't remember who exactly puts it on. But it's like a well-being day, but it's kind of fun. Like it's not like self-help day. It's just more like a day to go listen to experienced professionals, successful professionals, talk about something specific about their journey. It's supposed to be inspirational. Last year we had Corey Chetty. Anybody go to that? feel like you should have for one of my classes.
I was only there for like the first two speakers and then I had to leave, so I didn't actually get to see the main keynote
Okay.
speaker. I left right after Keith Warner spoke.
Okay, yeah. They're usually pretty good. I generally get really good feedback from students on it that actually go. You know, they try to keep it lively, they try to keep it fun. Obviously, we have class Tuesdays and Thursdays. So I'm not gonna take you to it, but I am gonna take our intro to business class that Wednesday. If you go to this on your own, if you go to either the 9 a.m. one, 10 a.m. One, or the 11 a.m. presentation, I get 10 extra points for that too. But again, you gotta email me, let me know you went, and then I can double check that with the keep like over. Tally on who showed up and did. Anyway, chance to make some easy points, maybe skip a homework assignment. And not hurt your grade. Okay, so. Talk about the different types of taxes. Talk about kind of the importance of knowing the tax laws and tax codes and having at least some general understanding. It's all about lowering your tax liability, right? I mean, shouldn't it be? I could pay 12,000 in taxes, or I could pay 10,000 in taxes. Right? You obviously would want to pay just the 10. And a lot of times you can do that as long as you kind of understand how it all works. And find ways to lower that tax liability. And it starts with first determining your adjusted gross income, right? And this starts with determining first your taxable income. How much of the money that you made in 2024 is taxable? Or whatever year, I guess we're late in the year, but that is the net amount of income after all deductions on which income tax is computed. Gross or total income has three main components. Consists of, you're gonna wanna know this. Earned income. What's earned income? Just off the top of your head, what do you think that means?
Like in 95.
Yeah, it's the money you worked for and got paid. For most people, it's their salary, right? It's made of investment income. Now, off the top of your head, I'm assuming you're thinking the money I make from investing in stocks, but that's not actually true. Stock investments, if it's short term, meaning if you buy it today and in 3 months sell it, keep whatever you made, then yes, it would count. But most people buy stocks and hold it for at least a year, in which case then it becomes a capital gains tax and does not count as part of your investment income. It's a different kind of tax. When they talk investment income, they talk more about dividend payments. If you invest in a stock that pays dividends, then that dividend payment is income. If you buy a CD and it pays you 4% for the year, that is considered investment income. Or any sort of rent, right? You own a rental property, paying you $2,000 a month, that is investment income. But it all counts the same as your job income. It's all part of the same.
What's a dividend?
A dividend is, it's a good question to ask now, because we won't get there until, I think, mid-November. So you buy a share of a stock, any stock. Well, I'll use Apple because it's easy, everybody knows it, and they pay dividends. Right, so let's say I buy one share of Apple. Apple offers a dividend. Not all companies do, but Apple does. So I bought Apple stock so I could get the dividend. The dividend is just kind of, it's what the company does with the excess profits. It's kind of like sharing back to the community. It's giving cash money right back to anybody who owns shares in their company.
So you invested one share, so every like return that they have, they give you $4 back.
Right.
Just on top of already growing and that stuff as well?
Yeah, exactly.
Okay,
Yeah, so you still get the kind of the capital gains in, return if Apple goes up 10% that year. But you would also get, like Austin said, let's say it's 4, I don't know what it is, but let's say the dividend for this year is $4 per share, which would be $1 per quarter, because they pay out quarterly. So, and I own 10 shares of Apple, so then I would get $10 per quarter cash money. They just send you a check. They probably don't send you a check anymore. They'll probably deposit it electronically into your account, but does that kind of make sense? Dividends are not guaranteed and they don't have to give them. Just because Apple declares a dividend, says we're gonna pay you a dividend, they don't have to. They reserve the right not to. It all depends on the amount of profit they make for the year and what they want to do with that profit. If instead Apple wants to build a new building in China for, 400 billion, they're not gonna give you the dividend. But they'll say, we're just reinvesting this money for you anyway, because this is gonna help the long-term growth of Apple anyway. So you'll win either way. Or we could just give everybody $10 a quarter, and then our stock won't go up as much, and you may not make as much money in the long run, right? So it's important to know about a dividend. It is income. It is ordinary income, so it's gonna be taxed as income, not a capital gain, and they're not guaranteed. But most companies who offer a dividend pay it, because it's enticing, right? There are stocks that are just pure dividend stocks. That's why they exist. All their profit goes right back to the shareholders. And people love them. You can get 7-8% a year off a dividend, almost guaranteed. Like there's a lot of older people do dividend stocks because they like that kind of almost guaranteed return. Okay, so but that's investment. It's not the money you make off Apple growing 10%. That's a different kind of tax. And then the third one is passive income. Passive income is earning money without really doing anything, right? Me and a buddy go 50-50 on a car wash downtown. He gets a salary for it, he does all the work. I do absolutely nothing, but every year I get a nice little chunk of money back from the profit. Right? That's just passive income. I don't do any work, I don't make any decisions, I don't get a salary. Just every year though, I get a little chunk of whatever chunk of the profits is left over after operating expenses and such. Passive income. You get to the point where you have high passive income, you have made it. Feel like that's a sign that you kind of made it. When you own some rentals and you don't do anything with, you're just getting that $2,000 a month in your bank. That's a pretty good feeling for what I'm told. Okay, any questions there? So those three things make up your gross income. Those are your three main categories of taxable income. Okay, but that is not the end all of what's going to be taxed, because there are exclusions to what can be taxed. It's hard to find examples of that. It's rare that you're going to encounter a situation where you have an income that's not taxed, right? But one example that the book came up with is if you buy a city bond, say the city of Casper needs to raise money to finally clean up their rec center. You've been in there lately, it's like walking on the beach. There's so much dirt and sand. It's uncomfortable, it's not fun. Maybe they finally want to clean it up, but they need money. They need money to do that. So they will issue like a city bond, or this is a loan program where you buy these bonds from them. They get the money to do what they need to it. And with a bond is basically a promise to pay you back in the future with a little bit of annual interest, right? City bonds pay almost nothing, like 2%. But that 2% is tax exempt money. Any profit you make off buying a city bond there is no taxes on it. That's supposed to be one of the incentives to do. So that's an example of what's an exclusion. So if you were calculating all this, that falls into investment income, but you get to exclude that when you're adding it all together, right? And then also there's tax deferred income. Tax deferred income, a perfect example, is the college. As an employee here, I get a certain amount of money every month dropped into my 401(a) retirement plan. It is considered income because they're paying it to me every month, but it's not subject to tax. Tax deferred. It won't be taxed until I take it out when I'm 59 and a half, right? Still part of my income, it's still on my tax form, but it is immediately excluded from taxable income because I can't touch it, can't do anything with it, so therefore it's not taxed until I'm 59 and a half. So anything invested in a traditional qualified retirement account is considered tax deferred income. If any of you have a 401(k) or your folks have a 401(k), that is all tax deferred income. All the money that the company puts in there on their behalf, tax deferred income. There's a whole chapter on retirement. So we'll talk more about that. All right, so this makes up your kind of your gross income. Now we're looking at the adjusted gross income. And all this is all of this added together. And then you come in with some qualified adjustments based on what the IRS says is a qualified adjustment, right? And I just mentioned one, a contribution to a retirement plan. Say I put 6,500 into my retirement plan, my own, not part of the school, but my own, then I get to then deduct 6,500 from my gross income to get to adjusted gross income. Another alimony payments. Wyoming doesn't have alimony, but if you were down in Colorado, and you got divorced and your spouse was paying you $2,000 a month alimony, you would have to include that now into your gross income to make it get to your adjusted gross income. So then you'd have to add 24,000, right? This starts to get a little more complicated than I like to get into because this is a bottomless hole. We could deep dive into the different kind of adjustments and how you finagle that and how you can get out of these adjustments. Until the end of time, I don't want to do that. So just know you start with your gross income, which is these three. And then once you have that calculated, you just add all those three up. Then you would find out what qualified adjustments you have. Change that. It can be plus or minus. Right, it could add to your income or it could subtract from it, like the example here. 6,500 in retirement, but then I received 24,000 for alimony payment, right? Okay, don't worry about tax shelters. I don't know why they throw it in here. It makes no sense to me. We're gonna talk about that down the road. So after all of this, now you have your AGI, which is also your taxable income. The amount of dollars you made in that year that is subject to federal income tax. Okay. Mina, you know what a tax deduction is? Heard about it? Kristen?
Why did it, but only with required income.
Okay. It's a qualified subtraction, deduction, qualified deduction from your AGI or taxable income, right? Some of you have heard of this, right? Tax deductions. I mean, if you're, somebody's a business owner, they're always talking tax deductions. How do I get tax deduction? You probably heard it all summer long from your uncle, right?
Uncle, cousin. Yeah, all that.
This is the key for Mitt Romney to only pay 11% in taxes on $80 million, instead of 25%. I mean, the difference between 25% and 11% on 90 million is a ton of money, right? It's knowing the the deduction, knowing how to kind of manipulate, what you can deduct from your taxable income. Sorry, I know I'm like standing right in the way here, but. So it's an amount subtracted from your AGI. To arrive at your taxable income. So I guess yeah, it's not technically, sorry, I jumped ahead of myself. AGI is not taxable income yet. AGI, you get your AGI, then you subtract out your deduction. And this becomes your taxable. We calculated our AGI here, right? We took our earned income, investment income, passive income. Then we made the proper adjustments based on what we made or what we spent outside of these three to get our adjusted gross income. From here, we start looking at our qualified deductions from that to get to taxable income. And so we'll jump into standard deduction first. Somebody want to take a stab at this? Standard deduction, everybody, I mean, probably have had to file taxes at some point. If you had any job ever, you filed taxes. I mean, I get it, maybe you didn't specifically do it, but taxes were filed on your behalf. Okay, that's all right. So standard deduction is basically the government saying, okay, if you file an income tax with the federal government, which if you had a job of any kind you did, we are going to give you a certain amount that's non-taxable for just living, for just being alive in America, right? In 2023, it was 13,850 for a single person, or 27,700 if you were married. So they're basically saying for the single person living in the United States, the government believes it costs about $13,850 just to exist.
Who's making
IRS. So that, you know, that is gas, that is food, that's housing, that's just whatever the necessary requirements for each person to live, to exist functionally without dying of starvation or something. 13,850. So they're giving you that much. They're giving everybody that much tax free. You don't have to pay taxes on that amount. Okay, if you're married, it doubles. They're going to give you 27,700 to a married couple, tax free. They're not giving you the money, but you get what I'm saying. They're allowing you to make that much money and not pay any taxes on it first, right? And it's called the standard deduction. We'll go over here. So we had our AGI. All right, we just calculated that. Now we're subtracting out the standard deduction. We'll assume, let's go with a single person, so that's 13,850. Let's say this whole AGI for the single person came to 67,000. We're subtracting out the standard deduction. That comes with that 53,150. Okay. Yeah. All right. So this person, this single individual, they just decided to take the standard deduction. Their AGI 67 took the standard deduction. They're only liable for taxes on 53,000. Okay. Any questions on that?
So they're saying,
No, sorry.
they're saying you'll survive off the 14,000, and then the 53,000 you have left over, we're gonna tax, and then that's all you have to enjoy.
I mean, you can look at it that way. It's really just saying that the government realizes it's not fair to tax people to eat food, right? Because without food, we would all die, right? It's not fair to tax people for having to drive to work every day to pay for gas, right? So we're not gonna tax you on the first 13,850. Because you need that just to be alive to work, to then pay taxes on the remaining amount that you made. Okay. I say, and does that make sense? Am I saying that to where it kind of? Like, they're not saying like you only get 13,850 to live on. Like that's what we think it takes to live, anything excess, that's just excess for you. It's just, they just calculated out an amount, and it probably is fairly complex how they arrive at that amount. That this is about what it should cost you to exist and to work. And it's not fair of us to tax that. I mean, people gotta live, I mean, they have to be alive to pay taxes on anything over that, so. So that's the standard deduction. Okay, most people take the standard deduction. It's easy, it makes sense for them. I made this amount, my taxable amount is this. Sorry, my AGI is this, deduct out standard deduction, whatever's left over is then taxed. So that's one way to do it. You can take the standard deduction. Or if it makes sense, you can do an itemized deduction. I think that is. Your
Like a
uncle
vehicle?
would do an itemized deduction.
Like, like office supplies almost, like go buy from a manufacturer specifically.
Okay, yeah. So if you do, people who choose the itemized deductions, what they are able to do is there's like a list of what's a qualified deduction for taxes, right? It includes many things. Especially if you have like a side hustle, right? You're an Uber driver as well. So if you're an accountant downtown during the day and at night you're an Uber driver, you get to then start looking at what do you have to do to be an Uber driver? Well, you have to buy a car. You have to do maintenance on your car. You spend a lot more money on gas on your car, right? You're changing your oil more often on your car. You're changing your tires a lot more on your car, right? Because you are now in your car a lot more than if you were not an Uber driver, right? So all of those things that you are paying for, the operational costs of being an Uber driver, then get to be deductible. The whole point is if you can come up with enough qualified legal itemized deductions that's bigger than this, then you take that number. You go itemized, right? So the whole point here is to get your taxable income as low as possible, right? So if you just take the standard as 1385, you're paying taxes on 53,150. But if you can go through the list and find 20,000 worth of itemized deductions, then you're only paying your taxable income then is only 47,000. Right? Does that make sense?
So like, just for like a tire company, they buy $20,000 worth of tires, they can file that as a common itemized deduction, right? So if we spend this X amount of tires, and then they don't get taxed on it. Whereas like,
Yeah,
if it
that's
was like a side hustle, I only bought like $2,000 worth of tires.
Right, that is, or a write-off, maybe you've heard of that, a tax write-off.
What's the difference between a tax write-off and then a common itemized deduction?
Same thing. Well, the tax write-off, like the write-off is a deduction, the legal deduction, right? You gotta write it off from being taxed. Trying to think like a better example, like usually you'd almost have to have a side hustle or something for this to make sense. Because you can't itemize, well, $20,000 of fireworks. The man's got to eat. Government's not letting you eat the fire off tax free. I get ribeyes 3 days a week, tax free, right? They have to be qualified deductions that the IRS says, yes, this is a necessity for this human being to live or to operate their business. So for it to be an itemized deduction, you almost have to have a side hustle. So before working here, I was a financial advisor and I itemized every year because I traveled a lot. It was beautiful. I would just get windfalls of cash back because I was spending a ridiculous amount of money on gas. I got paid for every mile I drove in my truck associated with my job. I was driving to Cheyenne twice a week. All my food, all hotels, all of that become tax deductions. So I made X amount of dollars, but my tax deductions were like 30, 40,000 a year. And that all was tax-free, essentially tax-free money. So I got to subtract that out, my adjusted gross income. And then my taxable income was way less. So I was in a extremely low tax bracket, but I was in a much lower tax bracket than if I had just said, you know what? I'm not feeling like I got a lot of energy. Maybe I'll just take the standard, call it good. Kind of the difference, like 10 grand. All right, I know this is probably confusing, right? I tell you, you got to read the book, you got to read the chapter, you got to kind of let it resonate. Look at it for what it is. Talking taxes here. The goal of every American, probably every human, is to lower your tax burden. Nobody likes paying taxes, right? You could save $500 on what you owe in taxes. That's 500 extra dollars you're going to spend on something else, right? It's just a way to have more money for yourself. And the decision between the two is going to affect how much you owe in taxes. The problem is most people don't qualify for this. They don't have enough going on in their life that they can show that it's more than 13,850.
Is that why they do like tax write-offs, so it's multiple things? Cause like just filing something as a tax write-off usually is like, this is $100, we'll make it a tax write-off. And then you like give them like a portfolio of write-offs that you made for your company at the end of the year.
Like the IRS.
Right.
Yeah, exactly. You have to keep track of these things.
Sure.
You can't, so that's a fair point to bring up. You can't, when you're filing your taxes, say, well, I mean, I drove to Berlin 6 times, work this month. Type it in there in TurboTax, watch that green number go up, your tax return bigger and bigger, and more money coming back. I mean, you can do that, but if the IRS looks at it and says, that seems suspicious, they're gonna call you up. Call an audit, probably heard of that. We need to see proof that you traveled the world 6 times, and not just proof that you traveled the world. Might be going there to see your girlfriend or your boyfriend. We need to see that you went there for actual work purposes. I don't have the proof because it wasn't true to begin with. So that's the scare. Is you can't just make stuff up and lie about it because the IRS can and has every right to call everybody out on their taxes and say, we don't believe you, prove it. If you can't prove it, then you're gonna owe that money plus a penalty. All right, again, don't sweat it if this is, if you're just not following very well. We're gonna hit this again. Either Thursday or next week. Well, a lot of this I'm gonna go over again. We'll try to plant some seeds. I don't like going over these. I don't know. There's so many numbers, so many different forms, W2, W2P, 1099, 1099, 1098. I mean, I don't feel like anybody's gonna walk out of here and remember what the 1098F was for. Oh, I watched that 1098F. Real life. All right, so the last thing, I guess, then we get out of here. Might be a little early, that's okay. So once you're able to calculate your taxable income, right? So we found out what our earned income is based on the money we made in our job. We then went to our investment account or whatever and checked out exactly how much we made off dividends, CD payouts, bond payout, anything like that. And we add that to the earned income. And then we go to if we have any passive income coming in, and we add that as well, right? Okay, that gives us our gross income. We have our gross income. Then we start looking, do we have any adjustments we need to make from incoming money or outgoing money that doesn't fit into one of these three categories, like an alimony payment. Or like a contribution to your retirement. So you find out that information, and then you either subtract it or add it, whatever it is, to these three added together, and that gives you your adjusted gross income. Once you have your adjusted gross income, you then figure out your deductions, your qualified IRS deduction. Most people take the standard. They just do, they just can't, they can't come up with enough BS excuses to get over the 13.8. And it's true, like the list will stop most people from doing that. So they take the standard and you subtract that deduction from your AGI and it gives you your taxable. Or you do the itemized, because you do have a side hustle. So you have other things that you can deduct to get over the 13.85. And so you add up all your deductions and then you subtract that and whatever to get your taxable income. Okay. Once you have your taxable income, you can then calculate what you owe the tax. Now, and this is 2025. Nobody pulls out a calculator and does all this on their own. Nobody's got the piece of paper and pencil, right? There are 1,000 online softwares and programs and platforms and calculators that will do this for you in 10 seconds, right? And TurboTax will do it. I mean, so knowing how this all works, probably, it's not applicable. Like nobody's going to go home next, 2026 and start, writing out all this information longhand and then doing the calculations. There's no need for it. But what I really like though is it's important for everybody to know the whys. You could jump online and find a calculator to do all this for you like that, but you don't know, maybe you don't know why. It's not going to tell you why it spit out, 8,000 in taxes, right? But I like the fact that it kind of goes through this and it shows you the steps, so you have at least some fundamental understanding of why you owe this amount in taxes, okay? So once you have your taxable income, now you can calculate your taxes owed, how much you owe to the IRS in taxes. There are two different kind of tax rates or tax brackets that you'll fall into, and you'll fall into both of them, not one or the other. They both apply to everybody. So the first one is the marginal tax rate. That's what United States uses a marginal tax system. Are you familiar with that? This was one of Trump's major platforms that he stood on in 2016. He was going to rewrite the tax code. He was going to rewrite the tax bracket. He's going to flip Washington upside down. He's going to drain the swamp. My favorite saying of all time. He's going to do all that. What he did. I mean, for better or worse, nobody knows yet, but well, it depends on who you ask. Anyway, it had to do with the marginal tax rates. The marginal tax rate is the highest bracket and associated rate that applies to your income. We'll show you in a second the tax brackets are the next page. So you have your marginal tax rate. That's the highest. So when you hear someone say, I'm in the 24% tax bracket, their marginal tax rate is 24%, right? That's the highest amount that they actually pay taxes at. It does not mean they pay 24% of all the money they made in taxes. It's a step-through process to get to that. But they do pay some of their income at the 24%. And then you have the average tax rates. That is the average rate of what they pay. That is the actual percentage that they paid on all their income. So if I were to ask you, what is the average tax percentage the average American pays? What do you think it is? So let's say I have $100,000 that I owe that is taxable income. What percentage of that do I owe? Well, I owe in taxes, my tax rate.
You said a little over 20% maybe?
You have a thought?
I'm just gonna say the same thing as the 25%.
Okay? Anybody else want to chime in? It's actually about 15.6. That's what most Americans pay in the average tax rate. 15.6 to 16.5, and something like that. About, we'll just call it even 16. 16% of their income actually goes back to the government. And I always thought, prior to teaching this, starting this class and reading this chapter, I always thought the same thing. Well, you're in the 24% marginal tax rate, means you pay 24% of your income back to the government. But you're the old timers all the time bitching at 24% tax rate. They take a quarter of my money. That's actually not even close to true. If your marginal tax rate is 24%, you're paying about 16%. They're taking about 16% of your money as a whole. Really quick, we'll end on this. This is why. So let's say that, I want to use a little more than that. Let's say that me and my wife are married, filing jointly. Let's say our taxable income after we calculated it out came out to be 211. Okay, just use 211,000. That's our taxable income. What marginal tax rate do we fall in? 35 or 32? Yeah, 24. So we fall into the marginal tax rate of 24%. Because we're between 197, 190,700 and 364,000. I think we fall into that. That's our marginal tax rate. But the way our step-through system works in America is the first 22,000 of that is only taxed at 10%, right? So take this, you back out. Actually, there's an easier way. So the first 22,000 is taxed at 10%. Then the 22,001 to 89,450 is taxed at 12%. So you would multiply 10% by the 22,000, right? That's 2,200. Then you would do the next step, 12% of the difference. You would subtract 89,450. You would subtract out 2,201. That amount would then be multiplied by 12%. Whatever that number becomes, you add it. Okay, and you do that all the way down until you get to our marginal tax rate. And essentially, you would take the remaining 211 minus the 190. And so that comes out to be about 21,000. We would take that 21,000. So only 21,000 of our dollars is actually taxed at the 24 tax rate. Right? It's a step up process. And so whatever this comes out to be, blah, 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 you at 21,000 or 2211, we probably actually only paid about 18,000 in taxes, which comes out to be like 17. We did not pay 24% in tax. But that's what it sounds like when you talk to people and they tell you I'm in a 24% tax rate. You're like, geez, that's 24%, that's a lot of money. So the marginal tax rate is the highest amount that you fall into with 24. The average tax rate is actually what you pay. The average tax rate is at the actual percentage of your taxable income that you. All right. We'll talk more on Tuesday. We'll probably do a worksheet, so I don't have to talk so much.
What? 6 or something?